you had mentioned there are some qualifying holding periods. So
Correct.
share with us what those are.
So in order to qualify for long-term capital gains treatments, there's 2 time periods that you need to be aware of. The first is you have to hold the stock for at least 2 years from the grant date.
Okay.
So the date that you're granted the options. If you exercise that option and then sell the stock before you hit that 2-year mark from grant, that would be a disqualifying disposition.
Okay.
The second one is and this is the one you might be more familiar with because it's the 1-year long-term capital gains rate. You have to hold the underlying stock for at least 1 year after the date that you exercise the option. So oftentimes the 2-year from date of grant isn't a big deal because of the vesting period. A lot of vesting doesn't start for at least a year, and so if you exercise the option on the date that you vest and then hold the stock for a year, then you've met the 2 years and you've met the 1 year. But sometimes that can get messed up, especially if there's been an acceleration in vesting of the options.
Right. So,
and that's a whole nother topic.
So yeah, which we'll actually talk about when we get into that red flags issue section on our talk. But what we're basically saying is under those 3 ways of selling options, if somebody exercises and holds, then they'll be able to meet those holding periods. But if they exercise and sell to cover, or they exercise and sell, then they're not necessarily going to meet those holding period requirements.
Well, that's correct. And if they exercise and sell to cover, then they have a partial disqualifying disposition on the stock that they've sold. And if they do a complete cash out where they do an exercise and simultaneous sale, they have disqualified all of those options.